Okay, class, so this is part two of chapter 11 on standard cost and variances. And we've already talked in quite a bit of detail about direct material variances and direct labor variances. Now we're going to look at the different overhead variances and then get into some of the journal entries. Okay, so first of all, you have variable overhead rate variance. Okay, so it looks somewhat like the direct labor variances, just using the overhead rates instead of the hourly rates for wages. So variable overhead similar to direct labor. And the first one is simply this formula. And again, I recommend highly that you print off your formula sheet that I made up for you, that one slide. And so we look at how do we calculate then the variable overhead rate variance. We're going to do the actual hours, okay, times the difference between the actual rate. And you'll see the actual rate a lot of times is given in kind of the extra little footnote stuff, and the standard rate. And of course, we know the standard rate came from our cost card that we did before we started this whole thing. All right, so here's the actual machine hours, 3,000, and we're looking at the actual cost of each machine hour, and we see that the actual rate is higher than the standard rate, so we know that's unfavorable. Whenever the actual cost is greater than the standard, it's unfavorable. And so our variable overhead rate variance is 10,200 unfavorable. The next one is the efficiency variance, and just like direct labor, we have an efficiency variance, and that'll be the standard rate, which we know is $25, and then we look at the actual hours, which is 3,000. That's also given to us. And then this important, and I bolded it and underlined it, the standard hours allowed. And whenever you have one of these calculations, you take what is the actual number of units that were produced times whatever the standard was for the production. So in this case, it's 0.10 machine hours. And so when we do our calculation, this turns out to be basically 3,100. So we know that 3,000 is lower than 3,100, so we have a favorable variance. You have to do the math. So our variable overhead efficiency variance then is favorable 2,500. All right, now I didn't mean to flip so fast, so if you want to digest this, just go back and look carefully at, and remember, if they ask you what is the overall variable overhead variance, then you have to put together both the rate variance and the efficiency variance, get the overall variance. Now, fixed manufacturing overhead is done a little differently. And of course, that's because when you talk about fixed numbers, you want to look at total amounts and not unit costs. Okay, so if you notice on our costing cards, we looked closely at the cost per unit, but again, with fixed overhead budgeted variance, we may need to calculate using some of the unit costs, but we actually are looking at the total amount. And this first one will be the difference between the actual fixed overhead cost and the budgeted fixed overhead cost. Okay. Now, the other fixed overhead is the volume variance, and that's going to be the difference between the budgeted fixed overhead and the standard fixed overhead. All right, so just reminding you, let's go back to, so here's our little sheet, and what I want to show you is that even though students have more difficulty with the fixed manufacturing overhead than any of the other, it's actually quite simple. And it has the actual fixed overhead minus the budgeted fixed overhead. And then we use the budgeted fixed overhead again here minus the standard overhead. So in reality, if you want to know what is the total amount, it's the actual minus the standard. And another word for standard is allocated. So that just kind of brings back memories of how we compared manufacturing overhead, looking at the actual and the allocated. The key here is that if you have to do any calculations, and most of the time you have to calculate the standard fixed overhead, you notice it's the actual quantity times the standard hours times the fixed overhead rate. That will give you the standard fixed overhead. The other two, most of the time they give you, but even if you have to do a little bit of calculation, there's only three numbers that you're really looking for, and typically they'll give you two of those three numbers. All right, so we're back at this slide, and it just reminds you that we're going to look at these two different types of fixed overhead variances. One is the overhead budgeted variance, and the other is the volume variance. And looking then at an example, so this is an example, we're going to do the volume variance, and that's going to be calculated by the, if you notice, this is going to be the budgeted amount, which we calculated, and then the standard fixed manufacturing overhead, which was the actual cases times the standard hours allowed times the fixed manufacturing overhead rate, gave us the standard, and all of the other rules are the same. In other words, if the budgeted is greater than the standard, it's an unfavorable variance. If the budgeted was less than the standard, it would be favorable. So all of those rules stay the same. Now, looking at journal entries, and sometimes I'll tell you up front, the journal entries take some time. You don't have to memorize them, just kind of have them in front of you. And, you know, there's a few rules to follow, like favorable variances will typically be credited. Okay, so favorable variances will be credited, unfavorable variances will be debited. So you can see here that in this case, we're going to record the purchase of raw materials, and that's going to be calculated by taking the quantity times the standard for the debit. The accounts payable is what the amount we actually paid for times the actual price, and then the difference of the two is made up with the variance. Okay, and I would just simply have the journal entries in front of you, because to spend 10 hours memorizing how to do journal entries is not profitable. Just have it in front of you. And remember that if you have a favorable variance, you're going to credit it, and if you have an unfavorable, you're going to debit it. Okay, so now we're going to record the use of direct materials. Remember the WIP account. When you actually use something, you put it into the WIP account. So here's the WIP account. Here's an unfavorable variance. We take it out of the raw materials inventory, so that's why this is going to be credited. Okay, so one thing I will point out is the actual amount that was used is different than the amount purchased. So that's why you have some different numbers here. So that's the amount that was actually used. And that's what brings in the variance. So it looks like you probably had 5,000, you know, whatever this is, the unit is, of waste. You can record the direct labor costs and put both variances together. Okay, so this is the unfavorable variance. This would be the favorable variance. Okay, and so you have the number of hours times the standard. Okay, and here you have the standard hours times the actual wage. Okay, sorry for the confusion. I just had to double check something. So the 1,550 that's the actual number of tortilla cases times the 0.05, which is the standard. So that's where this number comes from. And you can go back and look and see where it comes from. And then you have your two variances, and then your wages payable, the 1,500 hours is your actual number of hours times the actual cost. So the wages payable is the actual times the actual. And the variances then make everything balance out. The recording of the actual manufacturing overhead. Okay, so remember when you record manufacturing overhead, actual is a debit, okay, and then you have various accounts, could be anything, utilities, supervisor's salary, depreciation, whatever it is, but you're recording the manufacturing overhead. Again, remember, the journal entries are not that important. You just have to answer a couple questions and then you probably will never see them again. Allocating overhead, just like we did in earlier chapters. Okay, so that's when you debit work in process and you credit manufacturing overhead. And then, of course, when you complete it, you remember some of these, you put it into finished goods inventory, you take it out of the work in process inventory. And then, of course, at the end, when you sell, you make a sale and you release the inventory. So you're going to sell these. It says 32,370 cases were sold on account at an average price of $20.20. Here's the sales revenue part of the journal entry, and then the cost of goods sold, which here's our good old standard cost card at $12. And that goes into then the finished goods inventory, but that's what we use for the cost of goods sold. We close out our temporary accounts. Okay, so this is the different variances that we close them out. And you can see that this goes into our variable manufacturing overhead account, which also will be closed out later. Don't worry again too much about this. I'm just showing it to you. We close out those two variances, put it into the fixed manufacturing overhead. And so here's the standard costing income statement, which very seldom are you ever asked this, but if you want to see what it looks like, sales revenue, the actual number that we sold, the actual cost. Here's all of our price variances with our cost of goods sold and our operating income. So as I mentioned, don't worry too much about the journal entries and about the standard cost income statement. I just want to make it so that you've seen it. What's really important is that you have this page right here that I made up personally for you with all the variances, the abbreviation, and basically you'll use this more than you do anything else. 80% of your questions should come from these formulas. Okay, bye for now.